Well, I'm going to kick off. Thank you very much for joining us this morning. My name is Helen Gironi. I am Director of Ventures at Ufi Ventures. If everybody could turn off their cameras, please, if possible, and use the mute button, I think that will help. Please do put your questions in the chat function. We'll probably come to questions at the end rather than dipping into them throughout the presentation. But we would really like to be able to answer your questions, so do put questions in the chat. So welcome to our session on raising early stage equity finance for vocational technology businesses. As I said, I'm Helen Gironi, Director of Ventures. We have a £10 million fund within UFI that invests in high growth early stage businesses. And for those of you who don't know who UFI is, I imagine in the minority, we champion the power of technology for skills for work, and our investment fund very much mirrors that theme. So what we are aiming to achieve in this presentation essentially is to share some of the knowledge that my colleagues in the Ventures team and I have gained through our activity of making investments in early stage businesses. And this is really a range of information, practical tips that we hope just benefit people who are looking at whether equity funding is appropriate for them. So when and why would you raise equity, the pros and cons versus other forms of equity. Just to say we are recording, so hopefully that's okay. How to position your business for success, what you can do now that will position your business for success and help you make the fundraising process a smoother running. What's happening in the investment market, how much activity there is, for example, who's investing, who's not, and what to look out for in an investor, and what investors look for in businesses that they invest in. So if we come to the next slide, which is what is equity finance? Equity finance is typically early stage funding for high growth businesses, and investors do this in order to generate a capital return through an exit. So they're looking typically for an IPO or trade sale in the business to obtain their return on investment. Other sources of capital include private equity, so that's typically later stage equity investing. So more established businesses that have a high number of customers and are generating significant revenue. Debt financing, so this is obviously borrowed money, which doesn't dilute ownership, as you would get with selling shares in the business, and doesn't dilute control of the business. So a loan provider has very, very limited controls on the business. For example, they have a say in how much debt, further debt a business can take on, but wouldn't be able to get involved in the running of the business, the sort of wide-ranging decisions that the management team take in running their business. But you would make regular interest and principal payments with debt financing. So this obviously reduces the availability of cash to the business while you have debt outstanding. Included in this is revenue participation agreements, which we have seen quite a lot of, and this is where the interest payment is linked to the revenue that a business is generating. And another form of financing is invoice financing, so borrowing against the invoice sales. So when you've invoiced sales but you haven't got the cash in, you can borrow against those invoices. And that's particularly useful, I think, when businesses are growing at a high rate, a fast rate, and have added cash needs within the business. So it can be a very useful form of finance as sales begin to ramp up. Grant funding, obviously no repayment needed, no interest or ownership. So a very, very attractive form of finance, typically linked to a particular project, but so some restrictions over the use of that finance, but a very, very useful form of finance, particularly in the early stages of a company's development. So is venture capital right for me? Are you at the right stage, or really is your business suitable for equity funding? And I'd say that typically, if you are going for high growth, in the business, equity funding is going to be more attractive and more suitable for you. Obviously, the advantage is that this is long-term capital, so no interest payments will be due. So all of the cash can be kept within the business to drive growth. So to build up sales teams, to invest in technology, perhaps advertising, marketing, that kind of thing. All of the funding raised will stay within the business until exit. So until the other owners of the business are rewarded for the work that they've done in growing the business. So an alignment of interest really here between the founders in the business and the incoming equity holder. Also, something that equity investors provide is expertise and guidance. So sector expertise, for example, they know organizations within the sector. They maybe know the organizations that will end up securing the exit, will end up buying the business, and can guide you through the process. Equity shareholders do vary in terms of their engagement with businesses that they invest in. Often they'll take a seat on the board, or they'll ask to take a seat on the board, and will attend regular board meetings so that they can keep in touch with the day-to-day happenings of the business. But not always. Some funds will invest and then track what's happening in their portfolio of investments, but their focus will be on the new investments because of the sizes of their teams and limited resources really to invest time both in the companies that they've invested in and the new investments that they're making. So it varies, but typically shareholders do get more involved and are more engaged compared to other providers of finance. I think equity raising venture capital does provide crucial validation and credibility. Having a fund invest in your business means that they have been through a process in order to really understand the business, and their investing is really a huge sort of stamp of approval, which can be useful, for example, in making sales, in selling to large organizations. When large organizations know that you've got the backing of a fund that can continue to invest in the business, that also provides them with visibility that the business can navigate any shocks and continue to trade, which is, I think, often a concern that large companies have when trading with small businesses. On the flip side, there are sort of disadvantages, or there are, disadvantages compared to other forms of funding. The dilution. So your shareholding will be reduced. It is a time-consuming process, although that varies between funds. But what I'd say is that the first institutional fundraising you do will no doubt be a time-consuming process. There's a lot of learning that happens in terms of what the sort of typical terms are and the implications of giving away certain controls within the business. It's important to build a data room, to have visibility on the detailed information on the business. but the first time will pave the way substantially for future fundraisings and further rounds, particularly with investors that are already shareholders at a future date. Rounds will be much smoother running. So it's an investment in the founder's time now, but it smooths the way in the future. And just coming to the last point, there is inevitably some loss of control when you bring in funds into your business, particularly funds, less so with business angels that typically don't ask for so much control over the business. But there are certain requirements that funds and other investors have in terms of the amount of debt, for example, that the company can raise, in terms of the ongoing reporting requirements, that kind of thing. They will ask for these points to be included in the legal documentation in order to give themselves comfort, really, that the right processes are being adopted and that they will have the right of veto if they are particularly concerned about the financial vulnerability of the business, that it's that it needs shoring up, for example. So just wanted to run you through the equity funding ladder, and this is the various stages of investment rounds that companies go through. So starting off with grants, so this is grants and angel investors, really friends and family. This is often the first form of equity funding that businesses adopt. And typically you're looking at rounds of up to about £500,000. It's often dependent on SEIS and EIS compliance. So these are tax breaks that investors can secure. And typically there are restrictions in terms of applicability for that compliance, but it does make an investment particularly attractive to angel investors. So it's worth looking at the details on this. And the restrictions are the size of the business, that it's, for example, based in the UK, number of employees, that kind of thing, but definitely worth looking at. The pre-seed stage is sometimes where the first institutional investor the time at which a first institutional investor will invest, but often that is the seed stage round as well. So at the pre-seed stage, typically companies have a viable product, but don't have many customers, but have identified a clear gap in the market and know where they're heading. On the seed stage round, we're looking at funding rounds of £1 to £2.5 million. And as I said, often this is where the first institutional investor will get involved. So typically businesses have a proof of concept and have been validated in early market traction. So they do have customers that are increasingly buying more of the product or service. Series A investment really is where investors are looking for key metrics that show that there is real traction in the business, that there is consistent month-on-month growth in terms of number of customers, in terms of the typical purchase that they're making, and the ability of the company to resell to those customers, so to have recurring revenue from those customers, and also upsell, so to increase the ticket size, to increase the size of the sales that they're making to those organizations. And on the slide, we've provided the names of a few institutional investors and also angel groups. So just examples really of the investors at those stages. So positioning yourself for success, I think there is a lot that a company can do in order to make the fundraising process smoother. So really understanding the problem and the opportunity. The key thing here is, I think, to explain what problem you are solving in the industry. And this is the most important thing, I think, that investors want to know about. They want to know what problem you are solving, rather than just what the product or service is achieving, what the problem is for the user and the client. And if you can validate that through sales that you have made to those clients and show what problem you are solving for those individual clients and the different use cases there are for your product, then that will really provide the investor with confidence that there are other customers out there that will engage and benefit from your product or service. Have a clear go-to-market plan. So who are your target customers and why are they the most suitable customers in the market? How will you find them? How will you engage with them? How costly will that be? How many resources will you have to put towards each sale? And how can you make that sale more efficient? It's important to present the team and show the characteristics and the aspects of the team that bring, what skills do they bring to the table, essentially. There will always be gaps in the team at this sort of stage of investment, really until you get beyond Series A, I think. And that's not a problem for investors, but they will want to know that you know where the gaps are and how you can fill the gaps, what the strategy is really for filling the gaps, when you anticipate bringing on further resources, and do you have, for example, share options put aside to be able to incentivize those incoming talent to enable them to stay and really be aligned on the journey with the founding team and also the investors. And be prepared for the process. I think if you have an extensive, but not too extensive pitch deck that addresses the main points, that you're doing really well, you're setting yourselves up for a smooth running process. I think a data room is a really good idea, so that there is visibility on that and so that it can be updated, and investors can benefit from those updates in real time rather than, a slower process of coming back to you and asking for further information. So a data room, often we don't see at this stage, but I think really does have benefits in terms of efficiency and visibility for the investment community. I'd also say that frequently asked questions are a good idea. Having a document in the data room or a document that you circulate to investors is really a way of increasing the efficiency of the process. Similar investors will have similar questions for you. If you've articulated them well in a document, then you will reduce the amount of one-on-one interaction that you need to have with individual investors. Now, just looking at the vocational training, technology, venture capital funding landscape, there's been a huge spike in 2021 and 2022. There was a lot of investment fueled by what was happening in the pandemic and a focus in this area, but also a reflection of, general activity across different sectors as well. We have seen that drop back a bit, really because of slower growth within the business landscape, essentially, reduced economic growth, and a retrenchment from some providers of equity funding. High interest rates mean that debt is an attractive place, really, essentially, to put money at the moment. And there's also been a greater need for cash and liquidity. So that explains the dip. We do expect 2023 to not finish at that level. There is a huge amount of activity that's happening in the market. So we expect the overall level of funding for 2023 to far exceed what's shown on the slide at the moment. But we feel that it will definitely be less than the peak years of 2022 and 2021, and is likely to fall back to the sort of 2019, 2020 levels, or nearer those levels, but possibly exceed it. There are many funds that are actively investing. UFI is one of those funds, money that's been raised in the past that needs to be invested. So there is still a huge amount of activity. There are also funds that have have managed to raise further funds. So, for example, Bright Eye recently increased the size of its fund. Ufi Ventures has recently closed a funding round. So there is new capital in the area, and it's definitely not all doom and gloom, but just slightly a slightly more difficult fundraising landscape, with rounds typically taking a little bit longer to secure, to close, but it's not all doom and gloom. So this is my last slide. What to look for in an investor. It's important that you have choice in the market. It's important to find an investor that has a good fit with you. Will they provide valuable guidance? Do they have particular sector knowledge, for example, startup experience, or an understanding of the market that will help you, for example, secure an exit? Do they know the organizations that ultimately you think you might sell your business to? Do they have any other aims apart from a financial return? So, here I'm thinking about impact investors. So, for example, the UFI fund has a requirement or a focus on skills. So we're looking for businesses that are helping adults upskill, reskill. And it's important to have an alignment with the other aims that a fund, an equity provider has. Otherwise, there's, there might be conflict in the future, or a lack of alignment, meaning that fund then can't follow its money, can't invest in future rounds, which would be a missed opportunity both for the business and the fund. It's worth looking at what the investment time horizon is of the equity investor. How quickly are they looking to seek a return on their investment? How much pressure will they provide on you seeking an exit for them? Very patient capital is very, very difficult to find. There are patient funds where they're not under any particular time pressure to return money to their investors. So it's worth looking at where the money has come from. Are they investing their own money, or do they have investors that are expecting a return on the fund that they need to deliver returns for? So look at it's worth looking at who's invested in that fund, who the ultimate client is essentially. Can they invest over multiple rounds, or do they invest all the money up front and then not participate in future rounds? It's worth looking at what their reputation is like in the market. Do you know people that know them? Can you talk to portfolio companies that have received investment from them? And what do they say about them? How engaged are they? Have there been bumps in the road, and how has the fund navigated those bumps? And also the chemistry in the room. Do you have a good feeling, essentially, about the investment team? Do you trust them? What's the energy in the room? That kind of thing. So I think I'm handing over to one of my colleagues to do the next slide.
Hi, thanks, Helen. So before we get into a bit more about UFI Ventures and who we are and that, Alex will take you through that. I wanted to share a bit more about what trends we're seeing at the moment in the vocational technology sector. So we invest into what we call EdTech, and that sort of covers EdTech, HR tech, and future of work, with a particular focus on the UK market, but we look obviously to the global and particularly European and North American markets. As Helen was saying, the market is retrenching quite a bit, and investors are looking for validation of models, but we are also always looking for, new and innovative solutions, particularly in areas of the market we see huge potential. So I'm going to start in the areas that we're seeing a lot of companies come to us to pitch in, which might speak to you. So one example is micro learning. So that is bite-sized content, whether that's sort of TikTok-style videos to teach you how to use for hospitalities workers to learn how to use a coffee machine, to audio clips. And we've invested in a company called Assemble You that does 10-minute power podcasts, which to help deskless workers and workers on the go learn more effectively and in an environment that works for them. We've also seen a huge array of coaching solutions, for example, whether that is, competitors to Coach Up and Better Up, whether that is peer-to-peer learning through mentorship networks, or even that's coaching to help people find work from people that are already in work. Or even the platforms that back coaching platforms to provide more data analytics. We're seeing, particularly in areas of the economy with high vacancy rates, we're seeing solutions that target the training, because people enter sectors with high vacancy rates like hospitality, like the energy transition, need training to find jobs, as well as just the ability of searching for a job that fits you. And so we've seen a lot of promise there, as well as something really interesting. It's hit the news a lot with the writers' strikes in the US, but we've seen a huge amount of growth in creative economy VocTech solutions that we've never seen before. So this is really exciting, whereby we're seeing solutions tackle the challenge that's needed in this space. So helping people upskill, reskill into on-screen, off-screen production, content creation and writing roles. So again, I think that's a really exciting trend for us. But we're also looking towards the future. In the near future, we're seeing some essentially new trends developing at the moment. So for example, one is no-code platforms. So for example, this is focus, we often see boot camps and skills needed in DevOps and cyber. We've backed a cyber boot camp ourselves in Caps Lock. But we see that actually the change in the market, for example, particularly around data science, with a growth in no-code platforms, where previously to be a data analyst, you need to learn Python. And now we're moving away to platforms whereby you don't need that. You just need to be able to use the no-code platform to be a data scientist. So again, I think we're interested to see where the no-code movement goes. Similarly, I mean, it's everywhere, but generative AI is a hot topic, but we're actually not seeing many VocTech solutions make a step change yet using generative AI. And so we're interested to see where that goes. But saying that, proprietary data sets, so for example, around learning models with people who have different styles of learning, for example, neurodiversity or learning difficulties, those proprietary data sets are really interesting for generative AI, and we want to see where that goes. Again, over the pandemic and in 2022, we saw learning and VocTech solutions used for employee engagement, essentially to show employees that they're cared and looked after by providing access to learning solutions. But we're now seeing the market change to why the learning solutions were procured in the first place. So more focus on L&D budgets for L&D. And I think that's a great thing, particularly in the corporate learning space. Some of you may know that the sort of highest performing sector of EdTech in Europe last year in 2022 was corporate EdTech. So again, I think high potential there, for VocTech solutions as well. And then finally, I think we're seeing a lot of growth in what we'd call niche targeting. So whereby we see, normally the startup model, right, is you're trying to reach as many people as quickly as possible to get greatest validation for your work. But actually what we're seeing working for more and more businesses is focusing on a niche. So trying to win the most market share in your niche to then scale to parallel or related niches. So for example, I'm looking at a business at the moment with a geographical focus, and they're going to win in their sort of sub-region to then go to, go national, then global. And that's worked really well for them. So again, those niches could be local geographies. Those could be targeting particular groups, particularly marginalized groups, or it could be winning in a certain sector of manufacturing to then move to different areas of manufacturing with your VocTech solution. So again, these are sort of 4 key areas: no code, generative AI, L&D, and niche targeting that we're thinking to see trends in. And yeah, thanks, Alex, for stopping the slide. So we're going more to the future themes, where these are things that we're really interested in, but we weren't even seeing the beginnings of, validated and tested businesses in this space, particularly when the EdTech and VocTech niches. So again, these are things that we'd love to see more of. So one I'm particularly passionate about around green skills. So that's the skills needed for the net zero transition, whether that's more trained heat pump engineers and, solar panel installers who, on the more mature end of the market, just essentially improving competencies there, all the way up to the more innovative end of the sector. So you might have heard of Nopla, that won the Earthshot Prize there, who turns red seaweed into bioplastics. How are they thinking about skilling and reskilling? And again, I think that's a big green skills challenge, which hopefully will hit the VocTech market soon. Again, you'll see it in the news around older workers people who potentially also have lost their jobs due to automation, needing reskilling, retraining. Really, really exciting area of the market, which we'd love to see more solutions in, getting people back into the workforce, also that are marginalized or who don't have as much economic activity as they potentially could. So for example, disabled workers, how could VocTech provide results for them? And then there are other areas of the economy like construction, for example, whereby margins are really low, but people are aging out. And so how do we fill the demand? And there's sort of, very clear demand for roles till at least 2026 to 2036 in the UK construction sector. How do we find the solutions to fill those? And then the final point you'll see is just a sort of plus and a question mark. We can't always predict the future, but we'd love to see more solutions in vocational technology, trying to find solutions to the big challenges we see in this space. And I think that's where the creativity and ingenuity of companies of all stages being applied to EdTech, HR tech, and future work is really, really promising and exciting to see. And I know investors across these three categories, as well as generalist investors, are actively looking at these spaces. So hopefully that gives some insight into the market. But I'd like to hand over now to Alex, who take you a bit more through UFI Ventures.
Thanks, Anastasia, and good morning, everyone. Given the weight of questions in the chat, there's some really good questions. We want to give everyone a chance to throw more in and answer some of those. I'll be quite quick on this. As Helen said at the start, we are a specialist investor in adult skills for work in the UK. We're probably the only funding partner for that particular part of the market in the UK. There are broader EdTech focused funds, but we are unique in that way. And we've got a £10 million fund, and we've made 15 investments so far to date. We're still deploying capital, and we typically invest for equity in sort of the model that Helen was talking about earlier. Our first investments are typically around the pre-seed, seed stage, and then we have ability to follow on into subsequent funding rounds up to £1 million in each company. Our first ticket size range between 75,000 and 150,000. We have got scope to do slightly more or slightly less depending on the company. At the moment, I think we're very much focusing in on the seed stage market, but that said, if the opportunity is right, we would definitely look at it. As I said previously, we reserve funds to follow on. That is part of our investment strategy. We like to be a patient partner who goes on a funding journey with our companies. We are impact driven. We want these businesses to scale and do well, but also drive impact in the UK in our area. So that's really important to us. And what we offer is, I think most people on this call know about UFI. We bring that whole expertise and network of what UFI has been doing for the last 10 years. We've been investing since 2019. So, the grant side of the organization has that legacy and reputation that we are able to tap into as well, which is great for our portfolio businesses as much as anything. At the start of the year, we reframed our investment thesis. This used to be about 3 pages of text that was quite hard to kind of get any information out of. So we tried to make this a lot clearer for both our businesses and also what things that are looking to apply to us. So we've broken down our thesis into 3 areas, and these align with the wider UFI impact mission of what we're trying to achieve. So on the left-hand side of the screen, we have the ability for UFI and VocTech to drive skills development and flow of talent into areas of the economy that there are severe skills shortages. So, for example, cybersecurity and tech. There is a huge skills gap currently in cybersecurity, and in 2021, we found an amazing business called Caps Lock that provides accessible training for people who are looking to reskill into cyber careers, and they've placed so far more than 300 learners into roles. So really exciting impact and depth of impact there. Similarly, with Data Literacy Academy, there is a lack of data literacy skills across all organisations in the UK, and they're trying to run learning programs using real life examples that ultimately upskill people in data literacy. In the middle pillar, we've got, this is probably our broadest area. We enable wider adoption of vocational learning and better vocational skills development, and set several of our businesses forward in this, and probably there's overlap from other ones. Take Springpod, for example. They provide virtual work experience to young talent when they're making those critical decisions around next steps in their education or career pathway. So that ultimately is creating a better vocational route. They do a lot around apprenticeships and MBQs and things, so it's very important learning programs. Metaverse Learning is another one of our portfolio businesses focusing on VR, and they work with local colleges to essentially put content in a VR, in a virtual environment. And they're seeing really incredible results from learners through providing a different form of learning in local colleges. And finally, our final kind of area of focus for the thesis is around reaching underserved and hard to engage communities and providing them with better access to learning content. for example, Mobilize, who are a business who provides support and learning content for informal carers, which are a group of, there's 10 million of people in the UK currently who are in informal caring responsibilities, often thrown into those responsibilities with lack of understanding and lack of knowledge available. Typical provision is delivered by local charities, and they're providing a tech layer that enables the local authorities or councils to deliver a better service to those people and provide them with better knowledge. So ultimately, there's a great depth of impact happening there. Autonomy provides learning support and job support for people with neurodiverse issues and support them in workplace and getting jobs. So that's, again, incredibly depth of impact in supporting underserved and hard to engage communities. That is all we have time for on kind of the content we've delivered. I hope that's been useful. As I've said in the shares, as I said in the questions, we will be throwing out the recording of the session and also the slides post the meeting. We've also signed you up to our bulletin, which contains regular updates on what we're doing. And there's some additional resources at the bottom that include angel networks to tap into and different sources of finding information around different funds. So hopefully that will be of some use. And please do give us a follow on both Twitter and LinkedIn for regular content from us. We will quickly, given I think we've got about 5 minutes, go through some questions. So if I kind of, hopefully we'll take them with Elisade and Helen as well. I think there were a couple of questions initially around what is a data room. So if I quickly just take this quickly, essentially it is a repository of information that can be useful for your funding journey. So it can include your pitch deck, it can include your impact metrics. Often we see ones containing a question and answers document. So from the conversations you have with investors, you will gather the questions that are generally being asked. So it saves you a lot of time from having to answer the same question over and over again. And client data, CVs from your founder team. So a repository of information that you think will be useful for an investor relationship to enable them to get the details they need as quickly as possible. Tools for using this, we have seen them built on Notion. You can do it on Google Sheets and Google Docs. You can probably do it on Microsoft Suite as well. So there's no exact way of doing them, but they tend to be listed out and contain sort of relevant information if you're fundraising. There's a question here from Thomas, which I'll come to Elisade and Helen on. Could you outline the main things you want to see in a pitch deck? So again, bearing time, I'll give you 30 seconds each to go through that, if that works. Helen, come to you first.
What to see in a pitch deck? So a slide on who the team are and the expertise that they bring, their background, how the company fits within the competition. So a slide on competing businesses and how you compare to them. Some detail on what problem the business is solving. Those for me are the most important slides, and financials, basically what you've turned over to date, what you're projecting to do in the future, and some indication of where an exit's going to come from, who are you going to sell to, in what sort of target time frame, that kind of thing.
Great. Elisade, your thoughts?
Yeah, not huge amounts to add to that, but I would say to reinforce Helen's point about, what is the problem we were trying to solve and how have you validated this? So who are your customers? What revenue have you got? Or what partnerships have you got, etc. Anything to show that this is, you're really solving an actual problem through your technology. A bit of sometimes a link to a demo video would be really useful. And I think also just making sure that when you're spelling it out to us, remember that we're not all experts in every single area that you're in. So spell it out to someone that potentially has never seen the solution that you're looking at or know the subsector of the area. So that helps us all get on board with where you're looking, and then helps us, essentially have deeper conversations if we want to speak to you.
Yeah, agreed. I think being clear and concise in your messaging is the most crucial thing as well across all the slides. We get a lot of pitch decks and a lot of them have ultimately probably too much text, so just being as concise as you possibly can would be one tip I'd share. Coming on to another one, which is quite interesting, around Innovate UK and their focus on R&D projects founded by specific times. Are they a good resource for an early stage EdTech business that is not a pure research and development initiative? And is it possible to find a list of who they previously funded? Maybe we can reach out to them for advice on applying. Helen, I'll come to you first. I've obviously had some experiences with Innovate as well, so I'm happy to come on post you.
Yeah, no, it's definitely a resource that's worth looking into. We do see a lot of companies that get Innovate grant funding, and my take on it is that their definition of R&D is much broader than people initially think. So it is definitely worth looking into.
Yeah, I only thing with that is I'd say it's the process can be quite burdensome. You know, our grant process I think is probably a lot more efficient than Innovate, but at the same time, if you can get that funding again, it demonstrates that, you know, it's a validation point as much as anything. So I think definitely worth exploring. There is also an investor partnerships piece that we're aware of, and there are lots of investors who partner with Innovate to match funds. So it's again also worth looking at that, the funding partners, because it unlocks non-dilutive capital ultimately. LSA, you've got your hand up as well, so come to you.
Yeah, very briefly to add, I spoke to them semi-recently, and I know they've also got a creative economies thread going through them as a sort of new area that encompasses EdTech, but they don't have a very specific EdTech thread yet. But again, just to echo what the others said about R&D and investor matching.
Cool. Couple more questions, and then we'll let everyone go because we don't want to eat too much into people's time. We've got a question from Rich here. For an investment in a product, what would be a better approach? Investing in our company or creating a new company specifically for the product? So LSA, I'll give you this one first.
The chicken and egg problem, but if you're passionate about an area and you know that there's, you know, needs technology solutions to solve a problem in an area, then you should be, you know, your product should also you know, answer the same problem that you see. So, you know, don't create a company for a product, but hopefully create a company because you see a problem and the product should be obvious. But yeah, that's my take on it. Alex and Helen, if you've got something to add to that as well.
Helen, what's your view?
I would put the product into the existing business if you think that that product will be better developed and better grown with the use of the existing company's resources. I would also say that investors essentially are investing in a team rather than a company. So make sure that the people that are driving the growth of that product and the other existing products are only focusing on one business. Investors will feel uncomfortable if the resources, if the founder's week is being split between multiple companies.
Yeah, agreed. Just bearing in mind time, we've probably got time for a couple more. I want to let people go. We've had a question here from Ross, which is, what metrics or performance indicators do you associate with high growth potential in the VocTech sector? Are these specific revenue milestones, customer acquisition rates, or other KPIs you look for? Can you give a range of examples? Again, probably quite broad, Ross, but we can probably have 30 seconds each just to give you an indication. So Helen, I'll come to you first.
Great question, Ross. Yeah. Thank you. Revenue growth, obviously, you know, month on month tracking, but also looking into that revenue and seeing how expensive it has been to build. So one KPI that all investors look at this sort of stage of investing is expected lifetime value over cost of acquiring that customer. And that really shows you, you know, how expensive it's been to build that revenue, but also how secure that revenue is. So what are the churn rates within the business? How long do we think that revenue is going to last? Or, you know, do you sell to a customer and then, you know, for a couple of months and then they're gone? There are so many KPIs, but so many of them boil down to those three concepts essentially. So those are the ones to really nail, in my opinion.
Okay. Just one more. I think we'll come to Jill's question, which are: we are a consultancy and have a product, so we are looking to brand our product within this. Does this work? What are people's thoughts? I think, you know, from our side, we typically invest in technology businesses in line with UFI's focus, and you know, that's not to say that a consultancy arm of that can't be relevant, but typically from an investor hat on, consultancy is high cost and can limit scalability. But if it's adding residual value alongside a tech product, that can sometimes work. It just can sometimes be more challenging. Helen, LSA, any points from you on that?
I'd only add, I mean, Alex, I totally agree. I'd only add that the consultancy piece would be viewed as attractive if it is helping that company make sales and helping embed those clients and helping clients use the product. That being said, an investor looking for high growth businesses will only invest if the product component of revenue is much more significant than the consultancy revenue.
And I guess it's finding the right investment partner, isn't it? It's what we were saying earlier. There probably are investors out there who are more patient capital, are looking for different models, so it depends on what you're looking at. Just so we can complete the questions there, and I don't want to give quick answers. There's one question on, would we invest in another data literacy company given we've already got one in our portfolio? Because of our position in the market being very specialized in one area, we have to manage conflict really, really carefully. So ultimately, it would be quite challenging for us. There are other forms of capital that UFI supplies, so our grant making would definitely be open, but in our investment activity, it's really tough. But if you can create an angle that's very different, we judge it on a case-by-case basis. So please do still reach out and show, but we just have to judge it on a case-by-case basis. Right, I think that's the questions done. Thank you so much for being so interactive and asking so many great questions. Really, really useful. As the question Rich has come through, how do you start a conversation around investment? On the slide currently, you should be able to see there is a link there that enables you to get in contact with us, the contact form through our website. Please do reach out via that. We monitor that every day. Any kind of person who comes through that gets a response very quickly. So please do come through that, and we'll come back to you as soon as we can. As we said, the slides will be shared, come through in the recording as well. And thank you so much for dialing in and giving up your morning, and hope you've had some good learnings from it. Thanks so much.
Thanks, everyone.